Alright, here's another video from Alcos Ventures. Today we're going to discuss debits and credits. We've actually been making videos about finance, personal finance, understanding credit, debt and lending for the past couple of weeks. But we also realized that if we start at the very basics, things get a lot easier to understand as we go. So today, debits and credits. Alright guys, now if you do enjoy watching this video, make sure you hit the subscribe button and give this video a thumbs up. It really helps support the channel and helps spread the word and get it out there to entrepreneurs and people just like you looking for right, simple and actionable information. Right, let's jump right in. Let's first understand the myths of debits and credits. First thing, debits and credits aren't addition and subtraction. What it is, it's just a term to understand how money moves around in the financial system. For example, let's say you send money to a friend. The money leaves your account and gets deposited into your friend's account, which means the money debits from your account and gets credited to your friend's account. Now, let's explain with a simple example. Now, let's look at what's happening here, right? Now, let's keep it simple. Anytime there's a debit, that means money has left your account. Anytime there's a credit, money gets deposited into the account. To explain with visuals, let's say you're buying a product today and you're about to make the payment. What's going to happen is money is going to get credited into the account of the seller of the product. So you will see a debit in your account and a credit in the seller's account. So the reason we say debit and credit together is because it's actually a double entry system. So anytime there's a debit in any part of the world, ideally there should be a credit that is accounted into somebody's account to match that transaction, so it balances out. Now let's jump into Investopedia's website to understand what is double entry. Now, double entry is a concept that is in present day bookkeeping such that every financial transaction has equal and opposite effects in at least two different accounts, which means you send money to somebody, there is money received in that person's account, such that there is balance and there's also an easy way to track the flow of money. Now, if you actually look at any ledger, what you'll notice is that the debits are on the left side and the credits are on the right side. Now, the double entry system actually helped make commercial transactions and trade more efficient because merchants and bankers would understand how to calculate their costs and profits. Now, this actually forms the foundation of double entry accounting, and even today this concept you can see in the balance sheet. Now, if you'd like to understand the balance sheet more, we do have a video on this very channel that explains the balance sheet and helps you understand how to read and understand the balance sheet in totality. So go ahead and look at that. Now let's actually look at the key takeaways. What you'll see is that the assets equals liabilities plus owner's equity. Now this you will learn more about in the balance sheet video, and you'll also see that in the entire double entry system, transactions are recorded in terms of debits and credits. Basically, we're trying to see if the money left account A, we want to understand if it has been deposited in account B, just to make things easier from an accounting standpoint. Now let's go ahead and understand this example further just to make it easy. So a bakery purchases a fleet of delivery trucks on credit, which means the bakery has not actually paid for the trucks, but the bakery has promised to pay this amount to the seller, saying that they will pay. Now, in terms of how this is accounted, it might be different based on whether you want to account that today as purchase made today, or whether you want to account that as purchase made maybe month over month, and you have monthly payments. Let's say if it's 1 year, then you can actually record 250,000 divided by 12, and then put that as a credit into the seller's account every month as one single payment per month, or you can record the entire 250,000 as one full payment. So let's not get into that right now. Let's look at this example and try to create our own little sheet. So bakery purchased, let's just say 250k on credit, which means payment has not been made yet to the seller. And let's come back, and we are seeing that entries must be made in their respective accounting ledgers because the business has accumulated more assets. A debit to the asset account for the cost of purchase will be made. To account for the credit purchase, a credit entry of 250 will be made to notes payable. So let's just make it a little more simpler. I will say cash account and asset account. Right, I'm gonna go highlight this. So the merchant got rid of 250 and bought trucks which are worth 250, which means 250 has been increased in the asset account. Assuming, let's say, the buyer started off with asset value 0, but he had cash of 250, right? Which means now the buyer has spent his 250 but has accrued an asset value of 250. So the same 250 here is being deposited here. Now if we look at the seller's account, let's just say buyer and we'll say seller, right? So let's say in the seller's account, we'll once again say cash, and we can let's just call this truck, right? Truck account. So the seller initially had about 250 in the truck account and 0 as cash. This is an assumption once again. Once the purchase was made, the seller gave the truck and collected cash, which means his cash account went up by 250 and the truck account went from 250 to 0. So what you'll notice here is that there has been a positive value in the cash account because he has increased his cash account, but there has been a negative value here because he has decreased his cash account, which means that he has actually gotten rid of the 250 he had to make it stand at 0. We're not going to calculate the total here, but we're only going to notice how debit and credit has happened. So debit cash, credit asset, because cash is going away, asset is coming in, which means he's bought the truck. And for the seller, cash is coming in, which means credit cash and debit truck. That's what's happening. Now if you're still struggling to understand this, let's just look at this one diagram here. Money is sent from your account to your friends, which means money has left your account, and the same money has been deposited into your friend's account, which means your friend's account has been credited with the amount, and your account has been debited with the same amount, which means your friend got the money and you either bought a product or a service from your friend in exchange for that money. So money sent and money received. That is debit and credit. Thank you so much for watching. This is Financial Understanding for Entrepreneurs. We are coming out with more videos in the near future. Just go ahead and hit that subscribe button and like this video to support the channel, because we're trying to get the videos out to people and entrepreneurs and anybody that wants to understand finance, marketing, operations, product, and anything to do with kickstarting a successful business. Thank you.